The paradox that defines our world. Every nation carries debt. America shoulders $38 trillion. Japan bears $9 trillion. Our entire planet staggers under $315 trillion, triple the size of global economic output. Yet here lies the paradox. If everyone owes, who collects? The answer will shake you. When you trace the creditor chain, when you examine who actually holds these obligations, you uncover a disturbing reality. The world doesn't owe anyone specifically. It owes itself. 4 individuals, 4 banking visionaries across 3 centuries deliberately architected this reality. They constructed a framework where obligations never disappear, where governments perpetually borrow, where interest eternally flows upward, and where the system's creators profit from every payment, crisis, and rescue operation. This isn't speculation. These are documented facts. The meetings occurred. The agreements exist. The mechanisms are publicly recorded. Once you understand their construction, you'll realize that $38 trillion isn't a malfunction. It's the system operating precisely as intended. Let me reveal the 4 architects, the 4 pivotal moments when this trap was engineered, and why every government now finds itself ensnared with no escape route. William Paterson, The Foundation, 1694. The old system. Prior to 1694, monarchs borrowed through straightforward arrangements. They approached merchants or aristocrats, promised repayment with returns, and faced consequences. Unable to repay? They defaulted. Lenders absorbed losses. Kings sought new creditors. Risky for lenders, humiliating for monarchs, but contained. Obligations were temporary, either satisfied or abandoned. The system reset itself. The revolutionary proposal. William Paterson transformed everything. This Scottish merchant and financial innovator had experienced multiple failures before his breakthrough idea reshaped civilization. England was engaged in warfare with France in 1691. King William III desperately needed capital. Treasury coffers stood empty. Tax collections couldn't cover military expenses. Traditional lenders refused additional loans due to England's default history. The fragmented market. By the early 1800s, European governments embraced debt for wars, infrastructure, and operating expenses, but no organized market existed. Each loan required individual negotiation. Interest rates fluctuated wildly. Only the wealthiest merchants could participate. Nathan Rothschild industrialized sovereign debt. The network. The Rothschild family began as money changers and traders in Frankfurt. By 1800, the 5 Rothschild brothers had established banking houses in 5 major European cities: London, Paris, Frankfurt, Vienna, and Naples. This network was unprecedented. They could transfer capital across borders faster than anyone. They leveraged this to dominate sovereign debt issuance. Nathan Rothschild in London was the strategic mastermind. The innovation. During the Napoleonic Wars, Nathan arranged loans for Britain. His innovation was structural. Instead of lending directly to government, he purchased government bonds at discount and resold them to investors at markup. He created a secondary market. The flow. Government needed capital. Rothschild provided it immediately. He then sold bonds to pension funds, insurance companies, and wealthy individuals. Government received fast capital. Rothschild collected the spread. Investors obtained tradable assets. The dark side. Waterloo. But Rothschild didn't just finance governments. He positioned himself so governments had no alternative. In 1815 at Waterloo, Nathan Rothschild famously learned of Napoleon's defeat before anyone else in London. His courier network outpaced official channels. He exploited this information to manipulate the bond market. The strategy. First, he sold British bonds, signaling Britain was losing. Prices collapsed. Other investors panicked and sold. Then, after prices crashed, Rothschild purchased massive quantities at rock-bottom prices. When news of British victory arrived the following day, bond prices surged. Rothschild made millions not from what we'd call insider trading today, but from controlling information and market timing. The Rothschild model. This established the pattern: control information, control issuance, control markets. By 1820, the Rothschilds dominated European sovereign debt. Governments needing to borrow went through Rothschilds because they controlled the investor network, had distribution channels, and set terms. Why this matters for the trap. Before Rothschild, governments could theoretically refuse payment. If a king defaulted, creditors lost money and the system reset. But Rothschild made sovereign debt tradable across borders. A British bond might be owned by a French investor who sold it to a German bank who used it as collateral for a loan to an Austrian aristocrat. The ownership web became so complex that defaulting wasn't just refusing one creditor. It meant collapsing an entire international financial network. The Rothschild innovation. Make debt so interconnected that default becomes impossible, not because governments are responsible, but because default would trigger systemic collapse. The inescapable trap. Governments became trapped. They had to keep paying. They had to keep borrowing to pay interest on old debts. The debt trap was no longer just permanent, it became inescapable. The Rothschild family wealth peaked in the mid-1800s. They were the world's richest family, wealthier than any monarch. That wealth came from one source: interest on sovereign debt. They didn't produce anything, didn't build anything. They lent money to governments and collected interest forever. A system Patterson created in 1694. Rothschild industrialized by 1815. Every European government was caught. America's primitive system. By 1900, America was becoming an economic powerhouse but maintained a primitive financial system. Banks operated independently. Money supply was tied to gold. No central mechanism existed to manage debt. J.P. Morgan fixed this not for public benefit, but to protect his banking empire. The 1907 panic. In 1907, a financial panic erupted. Stock prices crashed. Banks failed. The economy seized. J.P. Morgan personally organized a bailout. He gathered major New York bankers in his library, locked the doors, and forced them to pledge their own capital to stabilize failing banks. It worked. The panic ended. Morgan became America's de facto central banker, but he was 70 years old. He knew he couldn't repeat this. So Morgan and his associates, America's most powerful bankers, designed a permanent solution. The secret meeting, Jekyll Island. They needed a central bank. But Americans despised central banks. The first and second banks of the United States had been shut down by populist opposition, so Morgan's group disguised it. In 1910, Morgan's associates, including Senator Nelson Aldrich and representatives from the largest banks, held a secret meeting on Jekyll Island, Georgia. For 9 days, they designed the structure of what would become the Federal Reserve System. Why secret? Because they knew if the public discovered bankers were designing the nation's monetary system, riots would erupt. The brilliant disguise. The plan was masterful political manipulation. What they called it, not central bank, the Federal Reserve System. Not one institution, 12 regional banks. Not controlled by Wall Street, overseen by a board appointed by the president. It appeared decentralized, democratic, and public. The reality, regional Federal Reserve banks were privately owned by member banks. Those banks elected the boards of regional feds. Regional feds elected the Federal Reserve Board. Government appointed some members, but bankers controlled the system. The most crucial power-creating money and buying government bonds was given to the Federal Reserve Bank of New York, controlled by the largest Wall Street banks. Morgan's banks. The passage. The Federal Reserve Act passed Congress in December 1913, largely because most representatives didn't understand what they were voting for. Immediately, the debt trap expanded. Before, the government borrowed from banks with limited capacity. After, the government borrowed from the Federal Reserve with unlimited capacity. Why this changed everything? Before the Federal Reserve, limits existed on government borrowing. Banks only had so much capital to lend. The functioning system. By the 1970s, the debt trap Patterson, Rothschild, and Morgan built was functioning globally. Every developed nation borrowed, rolled over debt, paid interest. But developing nations were different. They borrowed for infrastructure, and many couldn't maintain payments. The debt trap was reaching its limits until Paul Volcker made it permanent. The inflation crisis. Volcker was Federal Reserve Chairman from 1979 to 1987. He faced a crisis. Inflation exceeded 10%. U.S. credibility was eroding. Foreign governments were losing faith in the dollar. He needed to stop inflation even if it meant causing recession. His solution. In 1979, Volcker raised interest rates dramatically. The federal funds rate went from 11% to 20%, the highest in American history. This crushed inflation. But it had another devastating effect: the developing world crisis. Developing nations had borrowed billions in dollars during the 1970s when rates were low. Now those loans came due and interest rates had tripled. Mexico owed $80 billion. Brazil, $60 billion. Argentina, $40 billion. They couldn't pay. Interest alone exceeded their export revenues. In August 1982, Mexico announced it couldn't make payments. Default. The potential collapse. This should have triggered global financial collapse. American banks had lent most of that money. If Mexico defaulted, Citibank would take massive losses. Bank of America would take massive losses. Chase Manhattan would take massive losses. Some might fail. The entire banking system was at risk. Volcker could have let it happen. Let banks take losses. Let the market clear. But he didn't. The IMF solution. Instead, he orchestrated a bailout through the International Monetary Fund, IMF. The IMF would lend Mexico, Brazil, Argentina, and others enough money to keep making interest payments to American banks. The loans were called structural adjustment loans, and they came with brutal conditions. The brutal conditions. Governments had to cut government spending drastically, privatize state assets, sell national resources, open markets to foreign investment, devalue currencies, basically dismantle their economic sovereignty in exchange for money to keep paying interest. Here's the key: IMF loans didn't reduce debt. They just rolled it over, made it manageable but permanent. The Volcker innovation. When debt becomes unpayable, don't forgive it. Restructure it. Lend enough to keep interest payments flowing and extract political and economic concessions in exchange. The debt trap became a tool of control. Countries that couldn't pay were forced to open their economies, sell their assets, submit to foreign economic policy, all in exchange for the privilege of staying in debt. The repeating pattern. This pattern has repeated for 40 years. Greece, 2010. Couldn't pay debt. IMF EU bailout. Severe austerity imposed. Assets privatized. Debt restructured, not eliminated. Argentina, 2001. Economic collapse. IMF intervention. Social unrest. Debt rolled over. Sri Lanka, 2022. Defaulted on debt. IMF structural adjustment. Political crisis. Debt restructured. Every time the same structure. IMF loans to keep paying interest. Austerity imposed. Sovereignty surrendered. Debt never eliminated, just restructured, made perpetual. Volcker's legacy. Volcker died in 2019, but his legacy is the mechanism that ensures the debt trap is global and inescapable. Even when countries can't pay, they're not allowed to default. They're refinanced into permanent indebtedness. The interest keeps flowing to creditors, the same banks, the same institutions, the same system Patterson created in 1694. Summary of all four architects. Patterson, 1694, made debt permanent. Rothschild, 1815, made debt global and inescapable. Morgan, 1913, made debt infinite. Volcker, 1982, made debt a tool of control. How four architects built an inescapable trap. Let me show you how these four architects built a system where debt is infinite and escape is impossible. The layered construction. Start with Patterson's model, 1694. Government borrows, pays interest forever, never repays principal. Add Rothschild's innovation, 1815. Make debt tradable globally. Not one creditor but a web. Default collapses the system. Add Morgan's mechanism, 1913. Central banks create money to buy government bonds. Unlimited demand. Government can always borrow more. Add Volcker's trap, 1982. When countries can't pay, restructure, don't forgive, keep the interest flowing. The result today. What we have today. $315 trillion in global debt. Government debt, corporate debt, household debt. None of it will ever be repaid. All of it pays interest. All of it is connected through the financial system. So default anywhere threatens collapse everywhere. Following the money, U.S. government debt. Who owns the $38 trillion? About $20 trillion is owned by the American public. Pension funds, mutual funds, insurance companies, banks, Federal Reserve. These institutions buy treasury bonds because they're considered safe assets. But those bonds pay interest about $1 trillion per year. Where does interest come from? The flow. Taxpayers send money to government taxes. Government sends it to bondholders. Interest payments. Bondholders are mostly institutions owned by the wealthy. It's a transfer from workers to capital. Every year, forever, the government owes itself. The other $18 trillion is owed to the government itself. Social Security Trust Fund, Medicare Trust Fund. How it works. Government borrowed from these programs, spent the money, now it owes itself. But ultimately taxpayers owe because when Social Security needs to redeem those bonds, government has to raise taxes or borrow more to pay. It's a shell game. But the interest flows regardless. Global scale. The circular system. Every country runs the same system. Japan owes $9 trillion, mostly to Japanese institutions and Bank of Japan. Europe owes $14 trillion, mostly to European banks and ECB. China owes significant domestic debt held by state banks. The interconnection. They're all connected. Japan holds US treasuries, US holds European bonds through IMF, Europe holds developing nation debt through World Bank. It's circular. Everyone owes everyone. The interest flows upward to institutions that manage the debt. Why this can never end. Problem 1. The money supply collapse. If the US paid off its $38 trillion, the money supply would collapse, because dollars are created when government borrows. If it paid off debt, those dollars would disappear. Result: deflation, depression, economic collapse. So government can never pay it off. It has to keep borrowing, keep rolling it over, keep paying interest. Problem 2. Global scale. The same is true globally. If every government paid off its debt, global money supply would shrink by 2/3. Not enough money to conduct trade. The system would seize. Debt can't be eliminated. Who actually profits? The institutions that hold the debt. The real beneficiaries: BlackRock, Vanguard, State Street, Fidelity. These asset managers control tens of trillions of dollars. How they profit? They buy government bonds with other people's money. Pension funds, retirement accounts, 401k, ERA, insurance premiums, mutual fund investments. They collect the interest, about $1 trillion per year from US debt alone, plus interest from Japan, Europe, everywhere. The largest wealth transfer in history. That trillion per year in interest payments flows from taxpayers, workers, middle class to bondholders, institutions owned by the wealthy. It's continuous, structural, and invisible to most people because it's not called a tax. It's called debt service. But it's the same mechanism. Workers pay, institutions collect, debt never decreases. The numbers. How much money flows? Annual interest payments globally. United States, $1 trillion year. Japan, $100 billion year. Europe, $400 billion year. Rest of world, $500 billion per year. Total global interest payments. $2 trillion per year. This money flows from taxpayers, the public, to institutions, the financial elite. Every year, forever. Over 10 years, $20 trillion transferred. Over a generation, 30 years, $60 trillion transferred. This is wealth extraction on a scale never before seen in human history. Why the system cannot change? They didn't conspire together. The four architects didn't conspire together. They lived in different centuries. But each solved a problem in a way that benefited bankers. Each solution built on the previous one. Timeline. 1694 Patterson made debt permanent. 1815 Rothschild made it global. 1913 Morgan made it infinite. 1982 Volcker made it inescapable. Together, they built a system where governments borrow forever, pay interest eternally, the people who control the bonds profit continuously. The ultimate beneficiaries. Not governments. Not taxpayers. Financial institutions. The business model, debt as an asset. The final truth. $38 trillion isn't a crisis for them. It's a business model. Every dollar of debt is an asset on someone's balance sheet, pays interest, and provides collateral for more borrowing. As long as confidence holds, as long as people believe government will pay interest, even if it never repays principal, the system functions. Why confidence holds? 3 reasons. 1. Systemic interconnection. Everyone owns everyone else's debt. Default anywhere threatens collapse everywhere, so everyone protects the system. 2. Central bank backstop. Federal Reserve, ECB, Bank of Japan can create money to buy bonds. Ensures there's always a buyer. Prevents bond market collapse. 3. No alternative. The entire global economy runs on this system. All money is created through debt. Exiting the system would require complete economic restructuring. No country wants to be first. The trap is complete. Escape isn't possible, not without collapsing the entire financial system. What would happen if we tried to exit? Scenario 1. Government pays off all debt. Result: money supply collapses. Depression worse than 1929, global trade stops. Scenario 2. Government defaults. Result: global financial panic, banks fail worldwide, pension funds collapse, savings wiped out. Scenario 3. Government refuses to pay interest. Result: bond market crashes, no one lends to government can't function, social programs end, military unfunded. All paths lead to collapse. So the system continues. Must continue. The final understanding. 4 men, 3 centuries, 1 system. Everyone on Earth is now caught inside it. The architects knew what they were building. Not a bug in the system, not an accident, not a mistake to fix. They built it this way deliberately. What you're not taught in